ICO versus STO, how companies are raising funds in the digital era. In the digital age, the way companies raise capital has evolved significantly. Traditional funding methods like IPOs or initial public offerings and venture capital are still widely used, but the rise of blockchain technology has led to the emergence of new ways to raise funds. Two of the most notable methods are initial coin offerings or ICOs and security token offerings or STOs. Both ICOs and STOs provide companies with the ability to raise funds quickly and efficiently, but they differ in their structure, regulation, and the type of investors they attract. In this article, we will explore the key differences between ICOs and STOs, how they work, and why companies might choose one over the other in the digital era. What is an ICO? An initial coin offering or ICO is a fundraising method in which companies issue digital tokens or coins in exchange for capital, typically in the form of cryptocurrencies such as Bitcoin or Ethereum. ICOs became popular in the early days of blockchain technology, as they allowed startups and projects in the cryptocurrency space to raise funds without the need for intermediaries like banks or venture capitalists. The tokens issued during an ICO may serve various purposes, such as providing access to a platform, representing ownership, or functioning as a form of utility within a specific blockchain ecosystem. What is an STO? A security token offering or STO is another method of raising funds, but it differs from ICOs in that it involves the issuance of security tokens, which are regulated financial instruments. Unlike ICO tokens, which are often seen as utility tokens or digital assets without a claim on profits, security tokens represent ownership in an underlying asset, such as equity in a company or a share of profits. STOs are subject to regulatory frameworks, meaning that companies raising funds through an STO must comply with securities laws in the jurisdictions they operate in. This makes STOs a more compliant and secure method for companies seeking to raise capital compared to ICOs. Regulatory framework. One of the primary differences between ICOs and STOs is the level of regulation they are subject to. ICOs, especially in their early days, were often unregulated or poorly regulated, which led to concerns about fraud and investor protection. Many ICOs were launched without clear guidelines on how funds would be used or whether they would provide any value to investors. As a result, some investors were left with little recourse if an ICO project failed or turned out to be a scam. STOs, on the other hand, are subject to much stricter regulatory oversight. Because security tokens are classified as securities, companies conducting an STO must adhere to securities laws in their country of operation, such as the Securities and Exchange Commission regulations in the United States or the European Securities and Markets Authority in Europe. This ensures greater transparency, investor protection, and legal recourse in case of disputes. Investor protection. Due to stricter regulations surrounding STOs, investors in security tokens generally have more legal protection than those investing in ICOs. In an ICO, investors often purchase tokens with no formal guarantee that the company will deliver on its promises, and they have little recourse if the project fails. ICOs have been criticized for a lack of due diligence and a high risk of scams, with some companies raising millions of dollars only to disappear without delivering a viable product or service. STOs, in contrast, offer investors more protection as the tokens are backed by real assets or equity. Investors are typically provided with clear legal agreements outlining their rights, and they have the ability to seek legal recourse if the company fails to meet its obligations. This makes STOs an attractive option for institutional investors and more risk-averse individuals who may be hesitant to invest in the largely unregulated ICO space. Purpose of the tokens. The purpose of the tokens issued in an ICO and an STO is another key difference between the two fundraising methods. ICO tokens are generally used as a form of utility, meaning they are often intended to provide access to a product, service, or platform. For example, a company may issue tokens during an ICO to grant holders access to a decentralized app or network, or to incentivize users to participate in the ecosystem. These tokens may not have any real-world value outside of the specific platform, and their value is often speculative. In contrast, STO tokens represent ownership in an underlying asset, such as equity, profit-sharing rights, or a claim to a specific revenue stream. For example, an STO might involve the issuance of tokens that represent shares in a company, allowing token holders to receive dividends or participate in the growth of the company. This makes STO tokens more akin to traditional securities like stocks or bonds, offering investors a claim on future profits and tangible value. Funding potential and market appeal. ICOs have traditionally been more appealing to early-stage startups and projects in the blockchain and cryptocurrency space. They allow companies to quickly raise significant amounts of capital without needing to go through the formal process of issuing securities or seeking approval from regulators. ICOs often attract retail investors, including cryptocurrency enthusiasts and individuals looking for high-risk, high-reward opportunities. However, this market appeal can be both a strength and a weakness, as the lack of regulation and investor protections can make ICOs prone to fraud and speculative investment. STOs, while subject to greater regulatory scrutiny, are appealing to a broader range of investors, including institutional investors, venture capitalists, and accredited investors. The more structured and regulated nature of STOs makes them a safer investment option, but they also tend to raise funds more slowly than ICOs due to the added complexity and legal requirements. However, STOs have the potential to attract larger amounts of capital from institutional investors who are looking for regulated, secure investment opportunities in the digital asset space. Transparency and trust. Transparency is a major factor in the success of any fundraising campaign, and this is where STOs generally have an advantage over ICOs. With an ICO, the information provided to investors may be limited, and the projects are often not required to disclose detailed financial or operational information. This lack of transparency can create distrust among investors, especially in the wake of high-profile ICO scams and failures. In contrast, STOs require more transparency, as companies must provide detailed financial disclosures, project plans, and information about the underlying assets. This increased level of transparency helps build trust among investors and enhances the legitimacy of the project. Because STOs are subject to securities regulations, companies must comply with strict reporting and auditing requirements, which further improves trust and credibility in the eyes of investors. Liquidity and secondary markets. Another important consideration when comparing ICOs and STOs is the liquidity of the tokens. ICO tokens are typically listed on cryptocurrency exchanges where they can be traded, but they may be subject to significant price volatility due to their speculative nature. Many ICO tokens lack established markets, and the value of the token may be difficult to predict, making them less liquid than traditional financial instruments. STO tokens, on the other hand, are designed to be traded on regulated exchanges, which can offer greater liquidity and stability. Security tokens can be listed on digital security exchanges, which provide a more regulated environment for trading compared to traditional cryptocurrency exchanges. The ability to trade security tokens on these exchanges can make STOs more attractive to investors who value liquidity and market stability. Cost and complexity. Conducting an ICO is generally less expensive and less complicated than launching an STO. ICOs typically involve the creation of a white paper, token design, and marketing efforts, but they do not require the same level of legal and regulatory compliance than STO does. This makes ICOs an appealing option for startups looking to raise funds quickly and with minimal upfront costs. STOs, however, are more costly and complex to execute due to the regulatory requirements and legal frameworks involved. Companies must work with lawyers, financial advisors, and regulatory bodies to ensure that their STO complies with securities laws, which can involve significant legal and administrative costs.